Tuesday, March 31st, 2020, Maneco 64, home of alternative economics and contrarian views. This morning, I want to emphasize how I continue to see central bankers and also governments being helpless against the crisis that is ongoing, that their stimulus will not work, and I'm going to talk about why. And it's interesting because exactly 2 months ago, on January 30th, I made a video and it's entitled, If the C virus, I don't want to mention the word, I'm not supposed to, or I could, but I need to keep my videos monetized. So the title of the video, you will see the title. I'm going to put it up in the cards and in the description below. But it says, if the C virus is a black swan, central bankers will be helpless. So that was January 30th, 2 months ago. I'm not trying to brag here. I'm just trying to give you the reasons why I think that will continue to be so. Don't forget, January 30th, we still had the stock market near all-time highs. Stock market continued to go higher. I think it topped on February 12th. So no one was, at least the market, was not seeing this as a problem. And that's why I think the markets are going to continue to be proven wrong. They are behind the curve, in my opinion. So let's look into why. I don't think they'll be able to do anything. We've heard in the past, even from central bankers, from politicians, policymakers, they call these people, that in the next recession, they might not have enough ammunition, monetary or fiscal. And why? Well, because they use most or a lot of that ammunition to save the day after the '08 crisis. They've inundated the world with debt. I think the amount of debt that's not off balance sheet is like $250 trillion. That's not counting all the derivatives, and they are off balance sheet, of course. So we're talking about 1,000 trillion or more. And they also cut rates, interest rates, policy rates, the central banks. The ECB has negative rates. The Fed now has zero rates. Granted, when I made that video, I think the Fed rate was at 1.5, but they didn't have that much room. The national debt everywhere around the world, with the exception of a few countries like Russia, they don't have really a huge debt to GDP. I think it's like somewhere like 20 or 30%, very low. Germany, for example, even though I think their economy will have trouble, their debt to GDP is 60. US right now, as you can see by the debt clock, I remember just a year or so ago, it went above 20 trillion, or maybe a little longer, but now it's almost 24 trillion, as you can see. Debt to GDP is 109%. And more amazingly, if you go forward to 2024, which the debt clock allows you to, if everything remains fairly stable, the national debt will be at 33.2 trillion, or almost 140% of GDP. And I would speculate that it's going to be a lot worse in terms of being higher. So this is one of the reasons why I think the fiscal stimulus will not work, will not get the economy moving forward, because the burden of debt is going to hurt all sectors of the economy. The governmental sector, the corporate sector, the consumer sector, personal sector, municipal sector. Yes, the Federal Reserve is going to print trillions, unlimited, to try to keep interest rates low so that all these sectors can try to keep this debt going. But I think what that will do, that's going to completely destroy the purchasing power of the dollar, and it's going to make things a lot worse, and the economy is not going to pick up. So if you look back to the Great Depression, or just prior to the Great Depression, I found some data here on this website. I'll put it down in the description. You can have a look. the debt to GDP ratio in 1929, end of fiscal year, which is right around the time the stock market top, was 16% of GDP, not 16% of GDP. So there was a lot more room in the US for fiscal spending back in the time of the Great Depression in the 30s. And you can see that fiscal spending rose to 43% of GDP by 1939, just before World War II. So they had a lot more room back then to inflate the debt, to try to use a Keynesian toolkit, of course, which I don't believe in. Be as it may, that's what they did. The other thing most people think, and this is because of Ben Bernanke, who keeps harping about it. He's written a book, I think, about how the Federal Reserve was not quick enough to react in the 30s to the Great Depression or the stock market crash. But if you look at this website here, which I'll put again in the description, it's got a table with the New York Federal Reserve Bank discount rate. And back in 1929 and the early 30s. And I've looked here, just before the stock market crash, September 1929, the New York Fed discount rate was 6%. And by listening to people like Bernanke, reading his books, or you would think that they didn't do anything, right? But if you go to May 1931, they had cut that discount rate to 1.5%. So they had a lot more room, not only fiscally, but monetarily. And that is why I think it's going to be a lot harder this time to fight what I think is coming, the economic slowdown, which will be very, very hard for people. I think it's going to be worse than in the 1930s. A lot of people also argue that now we've got the social safety net. But I think the social safety net is being stretched. The baby boomers, how can I say, are increasing in size. They're going to keep increasing until 2030. So the demographics are not going to help that either. So it's a really bad cocktail, in my opinion. So that's why I think the central bankers and the governments are helpless. I think life will change on the other side of this crisis, whenever it ends. And what will that mean, briefly? I think people are just going to have to live more within their means. They're going to have to work for for their money. They won't be able to borrow as much. I think credit is going to be very scarce. I got a message from one of my viewers in Washington State. And you'd think with the Fed buying loads of paper, Freddie Mac, Fannie Mae paper for its balance sheet, that the credit system would be working. But this person told me that he knows a real estate broker, and there's a house for sale, and there were 3 people that wanted to buy the house, but they were refused the credit. So from Fannie, I think, or Freddie, I'm not sure. And it's strange because you'd think, well, the Federal Reserve is pumping all those hundreds of billions. Why isn't credit being given to these people? Well, probably because lenders are going to be cautious, because if you give someone a mortgage, is that person going to have a job in a month's time, 2 months or 3 months' time? It's very uncertain. And that's another reason, anecdotal reason. Maybe you know about similar stories, not only in the US, but in the UK. And you could comment below in the comment section. That would help. So yeah, it's going to be very different, I think. And people will need to adapt. Human beings adapt very well. Personally, I think it's going to be for the best. As I've said many times, this debt or credit-based system is unsustainable, and we need to go back to something more sober, I would say. So let's look at the markets now. It's 8:35 a.m. London. Yesterday, the stock market rallied after the 900-point drop on Friday. I still don't think we're out of the woods. So let's see where we are this morning in the futures. Precious metals are still a little bit under the thumb, so to speak, their prices. The physical supply, of course, for retail investors is drying up. I did an interview with Gold Investments yesterday, Oliver Temple. They're one of the few dealers that still have supply here in the UK. So right now, spot gold is at 1616, down about 5. Range has been 1631 to 1608. Just wanted to show you a monthly chart of gold because gold has been so volatile of late that you kind of need to look at it from afar and the bigger picture. And I think the monthly chart is a good chart. Of course, this could change by the end of the day. Today's the last trading day of the month, of course. We've actually had a very good month. We're going to finish above the previous month's close and above the January close. Yeah, we are below that 1700 level, which we traded up to, but the trend's still higher. As you see, the bar for this month is quite amazing, a very wide range, but that's going to be more and more, I think, common as the gold bull market continues. Silver yesterday got hit hard. It dropped like down well into the 13s. I'm not sure what the low was, but there was a story out that one of the big futures brokers tripled the margin for small investors who are usually long. And I think that's what got silver down. But it's catching up. I think silver will do well as well. I know that gold-silver ratio is ridiculously high. I think that will correct itself eventually. So right now, silver's up 10 cents at 14.14, up 0.75%. The Dow futures right now is up 62, S&P up 7, NASDAQ 100 future up 30. So they're all up about 0.25%. Expect still a lot of volatility. We're seeing sterling come back down. It rallied very strongly towards the end of last week, and now it's giving some of its gains back. We're down 1% at 122.88. Euros down 0.5% at 109.95, and the dollar is up 0.2% versus the Japanese yen at 108.44. WTI crude is up 4% at 22.65. What about the bond markets? Well, the bond markets, the yields in the treasury market are continuing to go down now after having spiked a week or so ago. Yeah, and why is that? Well, because I think the Fed is going to continue to try to keep those rates low because they need to monetize the debt that Uncle Sam is going to be incurring. We had the 2.2 trillion package. President Trump said, though, that the total will be 6.2. So you can imagine there's got to be a buyer out there, and that's going to be the Federal Reserve. And they're going to be buying corporate bonds, commercial paper, mortgage-backed securities, which they already have been buying. But as you saw from my anecdotal evidence, it's not really helping. So not too sure if this will help. So this morning we got the 10-year yield up about 3 basis points at 0.7%. The 30-year is up 5 at 133. What about the shorter term T-bill yields? Are they negative? Not really. Right now the 3-month is at 2 basis points positive, and the 6-month is at 7. So The bond market is very important, by the way. The size of the bond market is bigger than the equity market, and the bond market is where the corporations that are listed in the stock exchange as equities, that's where they get their funding. So we need to keep an eye on the corporate bond market as well. Right now, it looks like things have calmed down. I think what the Fed is trying to do is to drive the treasury yields lower so that investors go to the corporate bond market to get the yield. That's how they're doing it. They're also going to buy corporate bonds, of course. So there you go. It's not going to work, in my opinion. All the stimulus, monetary or fiscal. So what I mean by it's not going to work, I don't think it's going to reinflate the financial markets, and I don't think it's going to reinflate the economies going forward. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Facebook, BitChute, Steemit, and DTube. I wish you all a great day. Take care. Bye.